Hey, it's Phil Ratcliff with Rebel Financial, and thanks for tuning in to another one of our live broadcasts. Today, we're back in Columbus, freshly back from Chicago, and getting an update from all of our investment partners, whether they be managers or researchers or product designers. It's definitely one of the most important conferences that we attend. If you watched last week, you got a little bit of that update. Of our insight from that. I always like to take a few best ideas from every conference and find some way to do a better job for our clients, pass some of that knowledge back. So today we're going to kind of carry on with that theme, except to a more practical application to how we're actually investing. So we're going to give an investment update, number one. We're going to give a short economic update, two. And then number three, go over a little bit of the planning, behavioral trends that we're seeing and things that could actually help you a lot. So we're going to do a lot of screen sharing. We're getting ready to jump into that right now. So we're going to share my screen up there so that we can go through some of these things here. So let's look at this. And basically on the first couple things that we're going to go over, to give you a background of what this is we will take some of our different client portfolios that are actually real portfolios, change the account numbers, mix them together to have various different custodians, because we use TD Ameritrade and Schwab and Fidelity and TI Craft and Jefferson National. And so we mix those all together just so you can get a good mixture of some real insight to the portfolios that we're managing without necessarily, obviously, giving away any personally identifiable information. So it's real investments, it's real past performance that we're going over for the first couple of things. So this, you can kind of see here, the blue and the red on this graph are our equities. So those are the more aggressive things that should, over time, grow more, but they'll go up and down more in the short term. And the green and the orange are the more conservative, so our bonds and cash. And you can kind of see, for most of our clients, moderately aggressive is the most common allocation. And then we have some aggressive, probably about half as many moderate as the moderate aggressive, and then a few people that are conservative or conservative plus. So you average everything out, this is probably not far off from our practice in general. And then this style box is actually really important, even though most investors don't go over it, from whether we're value oriented, buying things on sale like Warren Buffett, or whether more growth oriented. And really, growth is what's done awesome the last 3, 5, and 10 years, especially large U.S. growth. And one thing that you'll notice with our portfolios here is that this is very balanced, and that's been very difficult for us the last 5 years, because we've had to take a lot from this and pass out more to the smalls and the value side of things. And that's very important, because this is diversification. This is keeping your eggs in different baskets so that you're safe going forward. And generally, over time, value does tend to beat growth, so we're kind of in a almost backwards intermediate time period. For our bonds, this is just a different way of looking at it in terms of like how high a quality do we have in terms of like credit score, so you're going to get less interest the higher it is on here, and then how long are we going in terms of to maturity. Basically, if you think about a CD, are we buying a 1-year CD, or are you buying a 10 or 15 year, right? And so this is that pie chart. So, we're mainly higher to mid quality and starting to extend our duration, which is probably a good thing for you. I'm not going to get too much into sectors and what's so, because I don't like people to get jerked down into the mud with that. You can kind of see our past performance. So we're at about 6 years right now. So our actual past performance has been about, net of cost about little over 6.3% versus the market's at about 6.61. So we are a little bit behind, and we'll go over a couple of the reasons why. But we're actually really close on top of there. We're very proud of that, especially given that we have a good amount of mid and smalls and value-oriented things, which have lagged behind, and we're still staying up with the markets pretty well. So that's really well, because that means that we've done well with something that's kind of been behind, yet you're very well prepared and have good allocations to things that are on sale. And when I go over some of the general things about the market and the economic update, that'll become more apparent as well. This one does a little bit of back testing when we just look at back testing from exact the snapshot of where we are. So you can see if we had been investing this way the last 10 years, we would have made about 11 and a quarter versus the market's at about 10 and a quarter. So that's great. And the worst 3-month down period over the last, I think this one's doing the last 5 years, was 14.68. And the best 3-month was 16.2. The worst 1 year was -10. And the best up year was +40. So you do have volatility inside of here. One of the things that I like to show people that's a major difference in what we're doing than the traditional benchmarks and traditional managers is that most traditional indices, managers, etc., are super concentrated in developed markets. Europe and Canada and the United States and Japan, etc. Versus with us, we keep a decent amount in emerging markets, which again, what I'm going to show you is a lot of the stuff that's on sale. And when you really think about the future, those are the places that have a lot of room to grow going forward. You can look at other different things in terms of like how expensive are, on average, the stocks that we own compared to the benchmark, and in every category, ours are more on sale. That's good. Again, we want to get good prices on things. It makes it more likely that you're going to make more. But on the flip side, for most of our metrics in terms of profitability, are right there or higher. So that's exactly what we're going for. We're trying to get better companies at a better price. And you can see our average expense ratio for this swath of our clients is about 0.46. Which is great. So I'm not going to get into the individual security selection. You can kind of see all of our different eggs in there that average out to, looking at our benchmarks. A little bit higher rate of return. It's got a little bit more volatility. But again, this is with the international exposure that we have in there, adding to that. So I think instead of just looking at the past like 5 or 10 years, when we look forward at the next 10 years, we will have a better rate of return with less volatility. And that is the goal of us money managers for you. So what I'm going to do now is I'm going to skip ahead and we're going to go look at this. And this is, let me make it bigger so we get less of the side stuff. This is a thing that Morningstar does for us. And Morningstar, we were just at the conference. They're our biggest kind of rating and research partner that helps us get the information, know what's going on, to help you build better portfolios, invest your money, and then also in times like this to kind of educate and update, okay? So when we look at this, you can kind of look, the S&P 500 is a decent proxy for large companies in the United States. The Russell 2000, looking at more smaller companies, this is the main developed international and emerging markets. So when you look at this, you can kind of see, man, especially U.S. companies have done awesome. And generally, the bigger they are, the better they've done, okay? And so when we come down and look at, just say look at this 5-year, you can see how much value has underperformed growth. And that's huge because generally when we look at like, say somewhere between 10 to 20-year periods, value tends to be growth by 1 to 2% per year. So like I said, kind of in this intermediate time period, we're really backwards. Guess where everybody, when we look at fund flows, is buying right now? They're buying this one. They're buying the large growth, like the NASDAQ. Even the S&P is more growth heavy because obviously the things that are done better are a bigger proportion of that index. And so again, what we try to do is get you very well balanced inside of here. And there are multiple reasons why, but even just the simplest is just reversion to the mean. Generally, when something is either below or way ahead what its long-term average is, big systems over long time periods tend to come back to what their long-term average is. And in that case, we don't know exactly how it'll happen or over what time period, but you'll probably see a resurgence of value to get back to its longer-term average, and some kind of underperformance, either hard, kind of like the tech bust, or gradual over the next decade. I mean, we kind of know what's going to happen. We just don't know how and when it's going to happen, okay? And so what we try to do, like we talked about before, is get your eggs into different baskets in a very smart way to protect you from that. So I'm going to skip around this thing because there are certain things that I want to point out. So when we look at this page right here, this is just showing you the last year, showing those trends. You can see, look how U.S. stocks, 9%, our emerging markets, -6%, and our developed international, -4%. Now the year before that was almost totally different. And so when we look at this, you can kind of see, here's 2018 right here, our best thing. when we're looking at just the calendar year were our bonds, right? Because remember how we went down a lot at the end of last year. The year before, our emerging markets was the best thing, but our international last year was our worst thing. And so again, this is why we want to rebalance. We want to buy low, we want to sell high. We don't want to think we can predict the future in the short term to say we want to buy this, we want to buy that. When we get into the behavioral side of this live broadcast, I see this a lot. When things have been really good or people get scared or they think that we're going into a recession, they're like, well, shouldn't we buy more bonds? Or, can I move stuff over to CDs? Or I went to this seminar about this guaranteed or indexed annuity thing. It sounds great. But again, all of these things are different variations of what we call market timing. And that means you trying to time the markets to buy something at a certain time. And generally when we look at all kinds of different time frames, and of course there are people out there that get it lucky, we call them outliers. Or you could be really unlucky, and that's the other side of outlying. But generally, market timing does not work. You will have a suboptimal performance, and we don't want to do that. So we want to have a good investment strategy and portfolio at the lowest cost that we can, and then over time, we need to adapt as things change. But generally, what we want to do is we want to buy low and sell high. And you've got to be disciplined about it. And it sounds so simple, but you know what? It's so hard to be disciplined to do. So I'm going to keep skipping here, and we're going to go look at some of the trends just in terms of, I'm going to go way down here for this, of what's just going on in the markets when we think of like how we're investing. And this is one of the things we see like when we go to the conferences or what so. And if we go down here, it's a very interesting thing because we've seen this over the last decade. Is passive investing's gotten really big, and what passive means is like indexing. I have people in all kinds of different understandings from different walks of life ask me all the time. So, I want index funds. How do we get index funds? Are you in index funds? Do you use index funds? Etc. And so the answer is we have been at the head of this for a long time since I've been doing investing, and for most of our clients, you've been very much a part of that movement of this index or passive movement. And you can kind of see here, this is the proportion over the last 18 years of how much of people's investments were in passive or index type funds, kind of like, it's what Vanguard's really known for, even though they do active and passive investing. But you can see it's really gotten big to where on the equity market, it's almost 50% of the market. And this is very important because it's actually great that this is happening because it has lowered fees across the board, even from the active managers, which means now we can buy some funds at a whole lot lower expense than we used to be able to do. And when there's only a few people indexing down here, there's a lot of room for if we can get that fund for, say, 0.1% or 0.2%, and most of the market is active, meaning that there's people out there trying to correct inefficiencies sometimes when they happen, then we're kind of riding on the system, and that's great to save the cost. Now that costs have come down a lot, and you're seeing this huge influx of passive, there could be a lot of inefficiencies develop over the next 1 to 10 years in the markets because people sometimes are not thinking about how they're placing money. So to give you an example, if we were just putting money into an S&P 500 index fund, the index fund in its purest form is only going to put proportionally how big those companies are more money in. So nobody's checking to see if who's in charge of that company is doing a good job, or that maybe the third largest company in there is way better than the biggest, but the biggest is 2 times as big, and you've got 2 times as much money in the bigger one that's not as good of a company. So those are just really simple examples of where you could see problems with index funds. And so at Rebel Financial, our goal for our clients is to try to get you the best investments that we can for the lowest price. And for the last 5 or so years, that's been 60 or so percent index passive and about 40% active, where we pay a little bit more for someone to be at the steering wheel. So I wanted to make you aware of that because especially when something really is taking on, and it's really taking on some steam now, people just think that that's the best and it's the only way to go. And it has been really good, but you got to be careful. And the more that people are jumping on that bandwagon, the more potential for huge volatility because you've got that herd mentality. So I could see us in the next 2 to 5 years actually pushing to where we're almost the opposite of that, and we're almost 60 to 70% active, but we're getting those managers at about half the price we would have been able to get them 5 to 10 years ago, which is phenomenal. But again, that's why it's good to have a fiduciary investment manager, and not just someone that's selling you something. And here you can kind of see these big fund companies out there, right? So like iShares and Vanguard are kind of the two biggest, like providing those passive investments right there. As I mentioned, almost half is Vanguard is active, even though people don't realize it. DFA is our second biggest partner. It's Dimensional Fund Advisors. Great company, and they kind of do like a smart indexing. They were one of the first ones to, if you've heard of the term smart beta before, I think really it was called that. We're kind of pursuing that. And TI Craft is our second largest custodian as well too. So a lot of these are big partners here. Some of our other partners that we use, American Funds is probably our biggest active manager, right behind Legg Mason's Western Asset, Fidelity, and T. Rowe Price. But again, we do a lot of screening in partnership with Morningstar and our staff to make sure that we're vetting these. And even when we do pay a little bit extra to have those active managers at the wheel, we're trying to do that for a really good cost for you. So I wanted you to be aware of that, because again, this is something that when we see almost consumer or investor demand for stuff, sometimes people want stuff because they saw something and it might have been right, a year or 2 or 3 years ago, and it still may be right in the future. There's got to be balance, right? And we got to think about smart ways to use the tools that we have. Okay, so I'm done with the investments right now. We're going to skip. Obviously, if you're a client, or even if you're not, if you got more questions, comment below, give us a ring. Next time you're in our appointment, bring it up. We'll go over it, okay? So now I'm going to go back to the economic side of things and kind of give you an update on this. So the first thing I'm going to go over, you may have heard this, because it comes out on all the popular networks, and sometimes it gets abused in terms of the context that it's put in, but how yield curves predict recessions and what's so. And when you just look historically, we're probably overdue for recession. Now, our recovery from how bad our downturn was in 2018, we could have probably, we kind of deserve a longer recovery, especially since it was lackluster. So it's not out of the total realm of things that could or should happen for us to go another couple years without a recession. But I would say we're probably somewhere within 6 to 18 months of a recession, if you just from listening to the economists and some of our different investment analysts and partners or so. But looking at this yield curve, you can kind of see the yellow line on here is how things were a year ago. This is pretty normal. So it's like if you're going to do like a 2-month CD or a savings account, you're going to get a lower rate. If you're willing to take 20 years, you're going to get a higher rate, right? It's normal, right? You can see now that the short-term rates are above like almost a 3 or 5 year rate, which is kind of ridiculous. And then you really got to get out here past like 10 or 15 years before the long rate gets over. And this is one of those things that, again, you may see on the news, and this is more the chart that they use, is to say when the yield curve inverts. So short-term rates are higher than intermediate or long-term rates, has been a fairly good predictor of recession. And so you can kind of see, boom, recession, boom, recession, boom, recession, and now we're down again. Not quite as deep as any of these, so it's questionable whether it's there or not, or whether this was kind of a fear reaction that we bounced back for since the end of the year. So again, there are some things pointing that we could be closer to recession. And so let's go down here some more. Get all the way to page 38 on this. Oh, that's it. And this is the other side of things of why it doesn't look. I mean, if you look at our actual GDP or gross domestic product, it's really good right now, and so things are solid and strong. Now, again, with trade war stuff and what so, you could have that hitting into reducing our GDP, especially if it spooks actual consumers from buying things. And when we look at this page right here, you can see inflation. Inflation's pretty steady. Wage growth has gone up. Those are actually really good things. So like the cost of things are not going up, but people in general, regular workers, have got more money. So that's awesome, right? That's another positive thing. And if we go and look at, let's see, the last graph I actually want to show here is way down here. So that's it right here. you can kind of see, trade was sluggish at the end of last year, really dipping down there. And who knows, maybe that was just the fear of people thinking that we were going into recession. Maybe it has to do with the trade war some. It's really tough to tell. But again, it's really mixed feelings about, are we going into recession within the next 2 years? Probably a high probability of that happening. Right now, lower probability. Somewhere in the midterm, probably where you're going to hit it. But again, we don't know. And one of the main reasons that we invest the way that we do, and all of you as clients are a little bit different for us, is we keep your eggs in different baskets. And over 70% of the time, the market's going to go up, and you're more aggressive. These U.S. and international stocks are going to make you more. And, the other less than third of the time, things are going to go down, and our good, more conservative things like bonds and some of our cash is going to hold you up. And then we'll buy these low. And this dynamic system together is one of the statistically, academically proven best ways to invest passively, so that you're not taking excess risk, you're being efficient, and as long as we take the right tax preferences, save appropriately, and plan, you have a very high probability of accomplishing all your goals. Is it sexy? Are we going to make 20 to 30% per year? No. You generally have to start a business or do something that's a good bit more risky to hit those types of rate of returns, but it's possible. So the last thing I'm going to talk about, even though this is a long one, it does always tend to be longer when I'm on here by myself. Right? But anyways, this is our portal for our clients. And of course, you know how this works. You can link everything in here. You can track spending. And one of the things that we see when we've had a really long recovery, even though we've had some dips in it, is that we see when things are better, especially now the last year and a half with wages increasing for a lot of people, is people want to spend more. They want to do more. They see other people doing things. They want to do it. This is the behavior side of things. And we have to be cognizant of what we're doing and how we're doing and whether it's going to work with your long-term plan. And hopefully there should be a long-term plan. So the main thing I'm going to focus on right now is major purchase planning. Okay? Say you want to buy a new car only 4 years after you bought the last one, or you want to buy a second house or a condo. Something big, right? First of all, you should have a plan to do this. You shouldn't just, so-and-so bought this, or you saw this awesome deal, and all of a sudden you're going to do it. Unless you're, got a bunch of excess money, which is possible, but that's not most of our clients. And so this is a big trap for a lot of people, because especially you get, a lot of our younger baby boomers and so now, that are, upper 40s to, just barely pre-60, you got a decent amount in retirement. You're starting to pay off, hopefully, at least more than half of your house. And so you've got these resources that you could potentially use. But the one thing I would say, you should almost never use retirement funds to do something like this, okay? Unless you're already retired and it's part of your plan. So if that's popping into your head as like one of the main ways that you can do this, it's probably a bad idea. Now you need to come talk to us. We need to model it out or what's up. I'm going to show you a couple of tricks you can use with this to kind of see and plan. But just FYI, okay? And when you say that you are going to do this, planning ahead of time, you need to say, how much do I need to put down? How much do I need to save? How much am I going to finance? And then in the end, is it something that depreciates away and goes away, and so really is an expense? Or is it some kind of asset? How do I divest it? And what will that look in my plan? So let me just show you how you can use this. So inside of here, you have the spending, and a lot of people don't use the spending unless we do a plan for them or what's so, but you can use this, not the spending, the goals. You can use this for little things like this. So like say we wanted to add a goal and say, there's all these different things inside here, but let's just say you want to buy a condo, okay? So we're going to say, I want to buy a condo. And on this one, it's not a full financial planning thing. It's just something for you, okay? And say you want to do this in 21, okay? Now, after we kind of figure out what you want to do, so say it's going to be a $150,000 condo, and you want to be able to put, let's just make it easy, and we're going to say you're going to put down a third of it. So you need to save up $50,000. So we're going to put this in here, make it a goal, and then we're going to come down here and say, what's the funding sources? So if you don't have one, you should probably make up some kind of savings account for that goal. Or if it's going to be longer term, we can set you up an investment account, and then you can tie that account to that goal. So now we can see, all right, based on what we have and how it's going to grow, this is how much of that goal is going to be covered. And if you say, all right, well, that's not enough, but right, I'm going to save into this account. So you can go over here, and you can. Oh wait, you want to go into the organizer, and you're going to go down to where it says savings right there. Okay. And down at the bottom, you can make sure that we have this all right for what's going into college saving or retirement plans or what so. But we can also add it for these types of accounts. And you say, all right, I'm going to put in $300 a month, so I'm going to be saving $3,600, right? Obviously, this is not going to be enough for this, but it's going to model it out for you so that you can see where it is, what you need to save. If you did put it in an investment account rather than a savings account, then we would have the rate of return higher for you inside of here. So now you can come down here and say, all right, so for what I'm doing here, I'm only going to be like 50% funded. So obviously we need to do something else. We need to get some more money from somewhere else. We need to back off how much it's going to cost us, or we need to save more per month or per year. And you could come in here, look exactly where it is. You can say, how am I funding this? And drop it down, and it'll show you where are those sources coming from. And basically what you want to get to, if you're doing all this planning stuff right, is 100% funded for everything. And the whole goal on this is, by the time you're getting pretty close to retirement, you can pay for everything that you need to do. We don't want to be doing a lot of financing unless we've just done the math and we could have paid for it straight up in cash, and it just works out better for you to pay the credit union 3% versus withdrawing out of an account that's making you 6 to 7. Okay, so not to say we won't ever finance, but we will have the ability to pay for everything, and that's where you need to get to. And so the last thing I'm going to leave you with on that behavioral side of things that I want people, this is, I mean, for us regular kind of middle class people that are saving up to have retirements, this is the path that you should be taking. So basically, when you're about 10 to 15 years out from when you want to retire, you need to be cognizant of this, and you need to be able to be at a savings rate of somewhere between 10 to 20%, just depending on how ambitious your retirement is. When you get in to 5 to 10 years, you should be able to save 15 to 30% of your income. And the reason I say this is, for most people, once their income goes away, we're just on Social Security and withdrawing from our accounts, that's about how much your expenses are going to go down, and we need to be able to live off of that amount of money. So really, saving, say, 20%, and then after you retire, needing 80% of your income is like a practice run at being able to be retired. Plus, it's a double whammy of being able to take that extra money and putting it to save to pad further your retirement. So if you are, like I said, somewhere in between that 15 to 5-year range, and you're not saving at the rates that I'm talking about, then you probably have problems either with how much we're spending, or what we're doing, or the timing of your retirement as well. So again, these are the things we do when we help people retirement plan. You have lots of tools inside of here you can use. I scratched the surface of probably 2% of what you can do inside of here. But I have seen this come up more often recently, and it's something that I want you to have in your mind as a client of ours, or as just anyone else, even if you're kind of doing it yourself out there. These are good rules of thumb that you should be doing, and if we're reaching beyond that, even though you do have the capability to do it, it could have very detrimental long-term effects, and we just got to get our mind right, because a lot of times our own worst enemy is ourselves. But if we know it, we think about it, we make good plans, we're going to make sure that ourselves are all right. So I know this has been a longer one. We gave you a lot of information. Investments are doing awesome. The markets are somewhere in between the end of our recovery and our recession coming up, but that's okay because we've already rebalanced. And when they go down, we'll buy low, we'll recover, we'll be on to the next recovery again. It is built in to your investment strategy. And then lastly, just be cognizant of where you are in your life, how you're spending, make sure you plan those major purchases, and that we get you set up to be successful, to not have to be afraid of running out of money, to be able to retire when you want to, have the life that you want to, enjoy your family, children, grandchildren, etc. So, thanks again for tuning in. Again, apologize, this is a longer one, but obviously these are all important things. Really wanted to kind of give 3 important updates of things that we saw happening so that you would be right at the forefront like us. So have a great finish of the week. If you're shooting with us tomorrow at our Sporting Clay event, we look forward to seeing you. And thanks so much for staying up with Rebel. And remember to subscribe to us on the YouTube. So we had to stop doing the live 360 because we got to have 1,000 subscribers. So help us get to 1,000, and that will be back up momentarily, hopefully. So talk to you next.